Hello, this is Dave Shepson. I am an accountant and instructor. I've been teaching accounting for several years and put together a series of videos to help introduce or review certain basic accounting concepts. This is the first of a two-part series about financial statements. I find that there's a lot of confusion about financial statements, especially when they're new. So what I like to do is, before we get into the details of what they are and how to create them and everything else you're going to learn in accounting, I'd like to step back and just take a look at what they are, what's on them, and how they might be used. This video is mostly going to focus on what's on the statements, what they tell us. The second video will be a little bit more about how they might be used. First, we are going to look at the income statement. And the income statement also, you might have seen it as a profit and loss. It's the same thing. But the key to all these statements and remembering what they are, what's on them, is it's in the name. Accountants are not creative. We don't come up with very creative ways of describing things, so we call things what they are. The income statement is about income, and it's a statement about income. Imagine that. It's going to show how much income you made or lost during a period of time. Most of the statements we are going to look at will talk about what happens over a period of time, like a month or a year. Here is an example of an income statement for a sole proprietor. All income statements are going to be basically the same. First you'll notice that it's for a period of time, as I have at the top here. This is for a month. Next, you'll notice that the first thing they show is revenues. Whatever types of revenues the company earned are going to be listed at the top. Then we start subtracting expenses. This is what's called a multi-step income statement because we categorize expenses into different categories. And so we'll see cost of goods sold and then gross profit. Those are a couple of the steps of the multi-step income statement. And then we subtract our regular operating expenses, general selling and administrative expenses they might be called. And after we subtract our expenses, we get our net income. Now that could also be a net loss, a negative number, if the expenses are more than the income. But what this showed is the profitability of the company for this particular month. Next, we look at a balance sheet. And the easiest way to remember what's on a balance sheet is if you've even just barely started in accounting, one of the first things you learn is the accounting equation. Well, like any equation, the equal sign means that it balances. Both sides of the equal sign are equal, and so they balance. Well, the balance sheet is called what it is because it's based on the accounting equation, and it balances just like the accounting equation. And the accounting equation, again, is just assets. That is everything the company owns or has the rights to of value are equal to liabilities, that is all the debts owed to any third parties outside of the company, plus equity, which is the share of the assets that the owners have a claim on. And so if we get all the balances of all of those types of accounts at one point in time, basically what we have is a balance sheet. It is a representation at a point in time of the accounting equation for a company. And that is one thing that's unique about it. It is showing your position at a point in time. The statement is also referred to as the statement of financial position. It tells you your financial position at a particular point in time. And here is an example of a balance sheet. All balance sheets are going to have these basic three categories. You see assets and liabilities and equity, and you see totals for those categories. And then if you notice, if we total up all the assets and we total up the amounts of liabilities and equity together, they should be the same number. And they are. One thing that is a little bit different about this balance sheet compared to a corporate balance sheet is when you look down at the equity section, a corporate balance sheet is going to have different types of equity accounts. They don't have capital accounts. They have things like common stock and retained earnings. So there are some other things on a corporate balance sheet that are a little different, but it's basically the same information. This is very useful information. We're going to look in more detail about how to use it in the second video. Next, I'm going to look at the statement of change in equity, also called the statement of change in owner's equity, or for the corporate version, the statement of retained earnings. And they all tell us the same thing. They tell us how that company's equity accounts changed during a period of time. Here's an example of a real simple one. Again, what it shows is the beginning equity account balance. In this case, it's a capital account because I'm dealing with a sole proprietor. And it's showing what happened to this account during the month of January. So we have our starting point, and then it shows anything that contributed to or took away from our equity and our ending equity balance. And this is important information. It shows us here that our equity increased $9,425 because of profitability. And it decreased $2,000 because of draws. That's money the owner took out. It's not business expenses that are paid, but the money the owner took out to for personal use. And so we can see not only how equity changed, but why it changed. And that's very important as part of the overall picture. Lastly, we're going to look at the statement of cash flows. And as you can guess, the key is in the name. It's about cash, and it's about how cash flows. How much came in and out, and what it came in from, and what it came out to. What are the reasons why cash changed? What was our starting cash position and ending cash position? And of course, this is also for a period of time. Here's an example of a statement of cash flows for a corporation. You'll notice there are three major categories of activities that we are looking at cash in relationship to. So our operating activities, this is what we're in business for. And so I always like to make the distinction that profitability and cash flow are not the same thing. As you can see in the operating activity section, we start with net income and then we make certain adjustments to figure out how much cash we actually collected or used as part of operations, because those two numbers are different. In this case, we earned $154,000 of income, but our net cash flowing in from operations was $117,000. And then we have investing activities, which is anything related to long-term assets, purchasing equipment or selling equipment or land or things that usually last a long time. And in this case, we had a purchase, so cash went out for that. And finally, we have financing activities, which is anything related to raising capital. And there's only two ways to raise capital. Raising capital is in distinction from earning money from profits. That would be in your operating activities. But raising capital would be either you can borrow money or you can sell ownership. So when we issue stocks and get money for issuing stocks, you're selling ownership of the corporation. Or if we borrow money through a loan or through issuing corporate bonds, that basically bondholders are people that we owe money to. And we get their money now and pay them interest, and those are all ways of raising capital. So anything related to that, equity or debt financing is going to be in this section. And in this case, we had paid down some bonds and other debts, and then we also paid shareholders dividends. So we had both debt and equity type of financing cash outflows. And we can see the net effect of this if we combine all three of those categories, operating, investing, and financing activities, was a net increase of $13,400. And we can compare that then to our beginning and ending cash balances and make sure we've done it right. But this is a very useful tool for getting insight into our cash position, how it changed, how much it changed, and why it changed. The next video is going to be about how we actually use these statements to understand our own business or another business if we are someone who has a vested interest in evaluating a business. And that kind of gets to the why. Why do we produce these statements? So stay tuned for that, and hopefully this will help you understand financial statements much better.